Welcome to TradeSpoon and Yellow Tunnel and Tradier Hub. My name is Valery Karpel. Today I'm going to talk about live trade. We're going to have live trading room broadcast, but also talk about silver, CPI, PPI data this week, macroeconomic conditions, and we're going to do an earnings play. I just finished the strategy in Oracle. We're going to talk about Adobe and how to take advantage of the volatility on earnings. For those of you who are new, welcome. If this is your first live event, then do me a favor, type in first. Always want to welcome new subscriber. This is my brief bio. One of the main difference between TradeSpoon and Yellow Tunnel, maybe other services, is that we have a team of financial engineers that are building neural networks and AI models. My background is technology. I was a CTO of several publicly traded companies. And we generate signals on a daily basis, and I trade these signals in the live trading room environment. I've been doing that for over 20 years. Disclosures are very important. Please read them. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. Also, it should not be assumed that the future picks will be profitable or we will pass performance. All right, let's take a look at the current market conditions. We're going to talk about silver, NVIDIA, and some of the other products. Let's see, super charts. All right, so first let's dive into the markets. So first let's look at the market spiders. Fred, good afternoon. How are you? Cecile, Patrick, Robert, how you guys doing? Thank you for joining. All right. So let's look at the market. All right. So 10-year yield after the CPI data and PPI data continues to drop, right? The important level is 4.30. We have a sharp drop after the PPI data, CPI data today that came in, weaker than expected. So inflation continues to go down, and you do have a pretty sharp drop to 424 level. We're below 4.30 level. We're below 50-day moving average, 200-day moving average. That's bullish for the market. Treasuries are up. And the result of that news, dollar also pulled back. It's rebounding now, trading between 50 and 200-day moving average. And value stocks are up. Technology stocks are up at all-time highs. Semiconductors at all-time highs. QQQ at all-time highs. Value stocks are underperforming. They were actually reached 50-day moving average. So everything but the mega cap technology stocks continue to underperform. And if you look at the small caps, they're fighting for the 50-day moving average, and the regional banks are also fighting for the 50-day. Robert, thank you very much. Best service out there. I appreciate that, Robert. Thank you for kind words. The regional banks are below 50-day moving average, actually dipping below 200-day moving average. Small caps are down. Let's see if I think they're fighting for the 50-day moving average, traded below, testing this week low. So the question is why? Why is it not a broad-based rally? Well, because if you look at the economic data, for example, initial claims today, you do see that unemployment, number of people filing for unemployment is rising. Some of the manufacturing activity is slowing down. So economic data in January is slowing down, but Fed hasn't committed to any rate cut, the timing of the rate cuts. Yesterday, we had a Powell's speech, and he basically reiterated that if we started the year with 3 rate cuts, they're now penciling only 1 rate cut, and potentially, same thing, it could be data dependent and not have any rate cuts, just because we had 2 months in a row where inflation went down and 3 months in a row where inflation went up. Fed is kind of hesitant penciling a specific rate cut. So that's something to consider, right? I still think it's a pattern of higher highs and higher lows. Spiders continue to trade higher. It's trading above 50-day moving average. Let's turn our attention to Tradier, our friends. We have Adobe announcing earnings and Oracle announcing earnings. We're going to talk about that shortly, but let's talk about spiders and positioning in spiders. So if you look at the spiders in terms of their positioning, you can see that this is, I'm looking at the Adobe, which will turn our attention shortly. But let's look at spiders, SPY, load. So it's taking a little bit longer than usual, but okay, so we'll let it load. But the positioning, in terms of position, we checked it this morning. There's a very high open interest at 530, basically 530, 535 is where the breakout is. And in terms of overhead resistance, it's 550, right? We're already at 543, so 550 is your overhead resistance. So there are signs of concern, right, that you don't have a broad-based rally because, before CPI and PPI data, the headline news was debt. We do have a lot of debt that's coming due in real estate and corporate real estate, and this is why regional banks potentially could still have more defaults, right? And you can see we are at 2024 low, we're at April lows, below 200-day moving average. That's bearish for the market. So you have small caps, mid cap, regional banks are underperforming. If you look at the metals and miners, they're pulling back today. Industrials, right? Metals miners are under pressure. Industrials are trading at April lows, not that far from April lows. Same price action in Dow Jones. You have transportation, extremely weak, below 200-day moving average, or right at the 200-day moving average today. Telecommunication has been weak. And Dow Jones, right? DIA is, let's see if that below or above 50-day moving average. So Dow Jones is dipped below a 50-day moving average. Today it's trading right below that, towards the session high. We're about 40 minutes away from closing. So that's where the market is. In terms of silver, this is one of my positions that I've been trading around precious metals. I think inflation is stickier than expected, right? I mean, it did subside. We had the 2 months where CPI is lower, and you can see silver drop to the breakout level, which is 27, trading right at the 50-day moving average. Still in uptrend. I would say uptrend is not broken as long as we're above this level. So personally, I would consider trade around position, be a buyer of silver. If you do look at the positioning of silver, there's still large demand for silver, right? You can see, so now we have spiders positioning. Let's see. So you do have the next level of overhead resistance is June 21. Let's see, July 19. So 550, right? So you have overhead resistances at 550, and the largest support right now is at 500 level, right? So that's 10% pullback, which is probably unlikely unless we have some kind of geopolitical event. But 530 is well positioned. So I think at least going into June expiration or even July earnings season, you could expect that 530 to be a strong support, followed by 510. So 530, 520, right? That's where the positioning is. First 530. And overhead resistance, probably, short-term 550 is your overhead resistance, and maybe consider selling calls when we do reach 550. Vol skew is still above 0.5, so people are hedging their positions, but volume is low during summer, so a lot less. So any questions on the positioning and the support and resistance level? Silver, TGX prep, good trade. Fred, nice. Now arrived. Bob, Lalit, perfect. Thank you. We have a full house today. Love it. Thank you for participating. Carol, thank you for leaving the review on Trustpilot. I really appreciate that. So Fred is taking profit in TJX. Let's look at TJX. I'm bullish on retails. TJX is trying to break out up another 1%. Let's look at the spread. Let's look at the position. That was one of the questions. TJX. Let's see. TJX. Last 7 days. So I bought it at $2.80. Let's see, what is it trading on? Let me look at real-time quotes. I'll turn on. Periodically turn on the camera so you guys can see me. But let's see, TJX. So it's trading, it's up 10%, right? So bought it at 2.8, the last sale is 3.10. I'll probably still stay in the trade. It's a July position, so we have time in TJX. But if you do have multiple contracts, more than one, I would consider maybe trimming as TJX facing overhead resistance, right? TJX, I mean, it could be a breakout, right? Or it could be just kind of a consolidation where it's trading in the range. But that's one of the trades. Also, we were talking about positioning, right, in terms of earnings. So Oracle was a pretty good trade. This is where you can, I risked 80 cents, right, 83 cents, and closed the position at $1.70. And right now, Oracle is trading, I think, at $4, right? So this is an example of asymmetrical returns where you are faced with a decision, right? We talked about as a trader, you are either want to be long volatility or short volatility, right? Short volatility, you assuming that volatility will collapse after the earnings, right? And you're not going to have more than 2 standard deviation moves. Then you deploy strategies like iron condor. You sell in premium, selling strangles, selling straddles, selling credit spreads. But if you want to be long volatility, right? If you want to be long volatility, then you would exercise strategies like butterflies, right? So let's look at our friends at Tradier again. Okay, so in a similar fashion to Oracle, we do have Adobe earnings. So let's see, after the close, right? So in the next 45 minutes, Adobe is going to announce earnings. Bob has arrived. All right. Fred, how are you? So similar profile, right? It's a similar profile to Oracle, CRM, HPQ. when you're in business of AI, even though Adobe is not creating, chips, or, this is not Microsoft, but they do build products for designers, developers that could benefit from with artificial intelligence. Uh, so far, their attempt to sell the story to the street, right, that they are able to actually monetize on, hasn't been very successful, right? We did this earnings last time. It was pretty successful trade. Again, was the idea that Adobe will move, somewhere between 10 to 13%. So first you need to look at the few things, right? You want to look at the to decide whether you want to be long volatility or short volatility. Do you want to execute buy strategy where you pay in debit, or do you want to execute a sell strategies where you sell credit? The first decision: do you want to be long or short volatility? When you look at the weighted volatility skew on your screen and it's under the 0.5, what it tells you is that what it tells you basically that when the weighted vol skew across all strikes and expiration is below 0.50, people are selling puts and buying calls. And this is an example of Adobe, right? You have a large positioning at the 400 level. People are selling puts, and it's called risk reversal, and they're buying out of the money calls. So the largest positions right now is at 5, I believe, 30, 545. 550, right? So you have 545, 550. This is the options that expire, weekly options that expire this week and next week, and monthly, right? And then if you zoom out to July, then you can see the highest position, including the July, is at 530, implying 40 plus 30 is $70 on the $500 stock, about 10 to 15%, right? 10 to 15% move, gravitating on a positive note. If they, and again, some people ask me, well, Vlad, does it mean you're buying or does it mean you're selling? No, what you're looking is a distribution of outcomes, right? You look at the probability where the stock can go, and you look at one standard deviation or two standard deviation. So in terms of positioning, people are highly concentrated at 530 strike, and they're highly concentrated at the 390 strike. 390 strike, implying 70 moves points to the downside, or implying um, 60, 70 points to the upside, right? So roughly 70 points to the upside or 70 points to the downside. 390 to 530, that is the range, and that's the distribution of an outcome. Does it mean it's going to get to these levels? No, but can it stay at this level? It definitely could. The probability is elevated at this point. So if you look at the uh, Oracle, right? Very similar setup. Oracle had very high concentration at 140, and actually 2 days in a row, the high open interest is at 140. This is where the implied volatility, right? The estimated move analysis for two standard deviation implied move to the 140 level, and also positioning. And in this case, it acted as basically a magnet, right? It acted as a magnet. It's just basically staying at 140 until all these positions got rolled out. Very similar last week, I did HPQ, right? We did this exercise, I think, together last week, if I'm not mistaken. Um, sorry, not HPQ, HPE, right? HPE, and we talked about 21, right? 21 strike. Closed HPE a little bit too early. It's up another 4%. But in any event, right? So I did a calendar spread, right? If we're gonna go through HPE, an example of HPE, what we did last Thursday, we talked about last Thursday. I did calendar spread, right? I did a calendar spread where I bought I sold June 7, 21 call, bought 21 call. The the June 21 expired worthless, but the next week continues to trade higher. So this is a similar setup to the Adobe, right? And notice HPE gravitated toward 21 level, right? That's important to kind of to realize. Obviously, I should have should have waited a little bit. But this is an example where you can have asymmetrical return, right? Where I put on a spread for 15 cents, and right now it's trading at 75 cents, right? So, and in this case, it does the 21 strike. The Vanna worked really well, right? It kind of gravitated toward the 21 strike, and now it's actually breaking out to the upside. Any questions? So going back to Adobe, similar setup. Does it mean it's going to move to 530? No, it could move to 390, right? That's 2 standard deviation move, or it could, stay within 1 standard deviation move, because more often than not, based on, distribution of outcomes, we know that most of the time the move is within 1 standard deviation. It will not get to this level, but because Adobe has high hopes and high expectations for AI, it could have these exaggerated moves, 2% up or 2% down, right? So how do you structure your trade? First, you want to look at the implied volatility, right? So we looked at historical volatility. Adobe can move. We've seen it last time, move 10 to 12%. These are, 2 standard deviation moves, right? And I just recorded a video on statistics and estimated move analysis. So you be on the lookout of the email to talk about estimated move, implied volatility, and historical volatility. Very important topics. But let's look at the option chain. And verify, is there a reason why people are so heavily concentrated at 530 for night? Is it just magic, or is it actually done by these models, right? Binomial models that looks at implied volatility calculations, right? Theoretical values, and placing these trades. So 458 estimated move analysis. Basically, you take a straddle at the money straddle, right? So you take asks $20 plus $20 at 40, and you add out of the money strangle, right? You add 2 asks at the money and the next level out of the money. Obviously, estimated move implied volatility calculation are a little bit more complex, but this is good approximation for the purposes of putting on a spread and figure out where the strike prices are concentrated. This is good enough. So 20 plus 20 is 40, 40 plus 19 is 60, 60 plus 80 is roughly $80. So if you take 460 plus 80, this is the 540 level, right? 540, 530 level, right? And you can look at the concentration at 530, 540 level, right? This is where it's highest interest, right? Highest interest, open interest is 533, 535, 530, right? This is where there's a lot more concentration at these strike prices. This is across just this Friday, right? But you want to do the aggregate of this week, next week, July, June, then you see the highest concentration is at 530, right? So implied volatility, matches, at least historical volatility, and it matches the high open interest. So if you have a positive surprise, right, it can gravitate toward 530. And then and so I propose to be long volatility. You can have different strategy, right? Because volatility skews all below 0.50. It's a risk reversal. People are selling puts to finance their long calls because the prices of options are very expensive. So I suggest either HPQ strategy where you do a calendar spreads, right? You can sell this week 530 and maybe buy next week 530. Let's see how much that will cost you. Maybe something to actually execute. So 530 costs you $2.20, right? If you sell it, you could sell it for $2.20. So let's compare that with the current strategy. So if you're selling this week, kind of similar approach we did with HPQ, and you buy in next week, and it could be diagonals, or it could be calendars, right? Same strike diagonals, calendar and different strikes diagonals. So if you buy in next week and you sell in this week, and you're basically there's no requirements, no option requirements, there's no risk. I mean, you're basically spending 79 cents, 80 cents in this trade. With the idea that it will get to 530, but not gonna break above 530 significantly, and you would have to wait till next week, kind of like HPQ, and see if there's a continuation for Adobe. I decided to do, um, let's see, earnings power trader. So I decided to use the butterfly, right? I'm buying 515, selling 530, and buying 545, right? So I'm doing one by two by one, right? And this is where I'm able to take advantage of the current market volatility, but risking only 70 cents, right? On the $500 stock, this is less than, what is it? 1% would be $5, right? So 10%, 10 basis points, maybe 10 basis points, right? 10 to 15 basis points. So I'm buying 515, 530, or 545 with the idea that the stock is going to just gravitate toward 530. If I do calendar spread and it gravitates toward 530, then I just have to wait longer, right? The 530 will expire worthless, and then I have to wait till next Friday for the stock to continue moving its direction. Here, I will realize the gains, right away. And same thing on the puts. We see that the 390 put is the highest concentration, and that's the middle strike, right? That's the middle strike. 390 was the highest concentration, and 530. You do have to have either very positive news or very negative news, or at least enough momentum for the market to move to that direction. And just a reminder in terms of profit and loss chart on butterfly, right? If this is the first time you see butterflies, like, Vlad, this is rocket science. I don't feel comfortable with this. So we're trying to simplify this. How do you simplify it? Well, you look at the profit and loss chart, right? You basically on the x-axis are the strike prices, right? In our example, instead of 100, we have high open interest at um, I'm drawing blank. High open interest at 530, right? So our strike is 530, middle strike. So the maximum profit, y-axis is a profit, is 530, right? The maximum loss, if it doesn't get to the buy leg, right? You have buy leg, you have two sell legs at 530, you have one buy leg, and then you have one buy leg at 545, right? It's a $15 spread. So the maximum profit is the difference in strikes, right? Which is $15. So the maximum profit is $15 minus the premium debit that I paid, which is $1.50. So I'm risking $1.50 to make $13.50, right? If it actually does like Oracle and stays, jumps to 530 and stay 530, these are the asymmetrical returns, right? That we talked about in Anti-Fragile. Nassim Taleb wrote in the book Anti-Fragile, kind of this a bell-shaped, this barb bell strategy where you keep 80 or 60% of your money in cash or secured investments, and you are spending 20 to 30% to execute these high return trades. These high return trades, right, asymmetric growth, they have lower probability of success, right? Stocks usually don't move to standard deviation in one day, right, unless it's a GameStop. Um, but the point of the book is basically to say that during certain periods of time or certain market conditions, when you look at the volatility term structure across all months and expiration months, you do have this elevated probability of stock moving within two standard deviations. So I'm just taking advantage of distribution of outcomes without having a strong opinion whether it's going to go up or down. But I do think that based on current market conditions and the pattern of movements in some of these earnings, that you do have elevated probability that the stock is going to go to standard deviation. Obviously, it's not guarantee. If it doesn't get to the strike prices, I will lose $1.40, right? 70 cents plus 70 cents is $1.40. That's my maximum. That is my maximum loss. And it's something to consider. $1.40 on $515 stock, this is less than 1%. So I'm risking maybe 30 basis points, 35 basis points. So this is an example. If you do credit strategy, well, and if you do the reverse, let's say you sell 515, 530 call, which could be one strategy, well, then, if you have if you have two standard deviation move, then potentially if you're off by 1 or 2%, that's 1% is $500, 2% if you're off is $1,000. So on a smaller account, you probably can never not do this. But if you have $10,000 account and you do one contract and you're down $140, well, I mean, I'm not happy about it, but it's less than 2.5% of your portfolio, a little bit more than 1% of your portfolio. So then these debit strategies will work. So buying puts and calls in general, the idea is that 70% of the time, 90% of the time, out of the money puts and calls expire worthless. But during certain volatility structure and term, right, when you see kind of fixed strike, vol, and high open interest, right, if you look at the gamma exposure, right, if you look at the gamma exposure graph that a lot of people talk about, this is where, if you look at the gamma exposure, you do have, elevated probability that dealers will be forced to defend those strikes, and it could act as a magnet or repellent. And I guess we'll see tomorrow. Any questions so far? Bob, Brad. Wow, we have everybody's here today. Bob, Fred, Cecile, Elite, Mahfouz, Patrick, Robert, Thomas, Michael, Steve, Jennifer. Appreciate your time. Questions? 315 on TGX. Fred, nice trade. CMG worth watching, trying to break out and split coming soon. I do like CMG. It did pop up on actually on a model, right? So you can always look at our tools, right? And we do have AI analysis for each tool, and you can just tell them, okay, Vlad, we like CMG. What does model thinks about CMG? It will tell you, right? Very strong uptrend, right? Very strong uptrend, potentially, getting to the 3,500 or even 4,000 level. So strong uptrend for today, predicted 31.15, 32.14, continues to break out, right? Up $82. Look at HP. Bob, did you hold on to your HP calls or no? Or you exited them out like I did? All right, and then CMG. You can't really concentrate on when stock is up. You stick to your plan, right? If the stock, if you made 50% return overnight or even in a week in this example, then this is good return. But yes, CMG is trying to break out. It may be struggling, but I would watch continuation on CMG, right? Apple is a perfect example from this week, where it's you have this clean breakout of. Is Apple all-time high? Let's see. I think it's all-time high. Yeah, you have a clean breakout where you have a multi 1 year overhead resistance since June of 23 of last year, accidentally June of 23 of this year, and you have a breakout, right? 12 months consolidation breakout. That is a healthy price pattern, and then you have a continuation. So I would follow stock like Apple as opposed to CMG, and same thing we can say about TJX, right? So that you know consolidated for 4 months, right? For 4 months, it stayed at the 100 level. You have a breakout on the earnings, and then you have continuation. Any questions? All right, Louis. Looks like camera is the trick, but now I actually have a camera. It's still working. Okay. Let me pause the camera to don't lose the connection accidentally. Any questions? Louis on the YouTube channel broadcast or SLV trade? Bob out. SLV, I mean, I'm still bullish on silver, right? This is the topic for today. I mean, the expectation right now, the theme, the narrative is changing slightly, right? Inflation is down, but so is earnings growth. So maybe it's not doesn't make sense to hide in silver because inflation is subsiding. Maybe we buy bonds, right? We buy bonds because we are potentially entering into recession. That conversation, that narrative hasn't changed, right? It's just it's kind of one narrative based on news. People jump from one narrative to another. My longer term perspective is that silver is in strong uptrend. Yes, it definitely broke out above 24 level. Did it pull back? Yes. Did it break this uptrend? No. Is inflation going away? Probably not. Right. The reality is that there's still a lot of geopolitical risks in Europe, China, United States, elections that I think as of right now, this is a healthy pullback, healthy, consolidation. I'm personally staying long silver. Bob's favorite General Electric is having significant pullback. So, looks like this uptrend, at least, it looks like a top building process, right? That this uptrend is broken and we are building top in some of the names in industrials. Losing a winning trade. Yes, you don't want to dwell on your trades. I agree. You stick to your plan, right? 50, whatever the target gain and stop loss, this is where you want to stay. And we talked about uh, quite often about prospect theory, right? So let's just review prospect theory. It makes sense to at least be aware, self-aware of these, examples. But the idea of prospect theory, right, which is well documented, studied in all the financial courses, right? Daniel Kahneman got Nobel Prize in economics. But the point of this is that we have asymmetrical returns. We also have asymmetrical relationship between our losses and gains. And when we confronted with two choices, right? You can keep for your $450, right? Or you could take 50% chance to make $1,000. All of us take $450 gain, right? And then when it moves to 1,000, we feel like, oh, I should have held it a little bit longer. And that's how majority of the people react. When you're 100% chance to lose $500 versus 50% chance to lose $1,100, guess what? We do the opposite, right? Instead of taking $500 loss, we wait and sometimes we have a loss of $1,100. So if you just keep in mind that example, then you'll realize that the most important is being consistent, right? Yeah, I could have kept HPQ instead of making 50%, I would make 500% return in this case, right? From 14 cents to 80 cents, it's 400% return. But the point is, I have to be consistent, right? And when I'm faced with the $450 gain or $450 loss, I need to be consistent, right? You can be consistent and just say, I'm always going to take 50 chance to keep it to 1,000 or 50 chance to 1,000. All you need is now odds where probability of success is greater than 50%, right? Because if you're up $500 and you're down $500 and you have same number of winning and losing trades, well, you're just spinning your wheels. But if you structure your trades, whether you long delta or short delta, or you have AI that gives you signals, right, that you can execute, right? Today, we were talking about in the live trading room, we were talking about aggressive power trader, right? In aggressive power trader, we have signals that are more than 50-50 chance, right? Probably 70% probability of success. Then, as long as you're consistent in terms of how much percentage gain percentage loss, right? I bought Microsoft instead of Google. I decided to buy Microsoft today, but that what generates, you become a disciplined trader. You become uh, a better trader and confident trader, and that's what allows you to continue to grow your account. Any questions? Robert, Patrick, Mahfouz, Lali, John, Cecile, Brad, Fred, Bob, Michael, Steve. Any questions? Louis, how are we doing on quality? Oh, okay. Video is up. 45 minutes. We're still in. Okay, so it must have been the video. Seems like these simultaneous broadcasts take a lot of bandwidth. But I think we found a solution. You guys can see me. Maybe, periodically I'll stop the camera just so I don't lose you guys. But most important is the screen. I mean, my face is not that important. Thank you, Louis. Appreciate it. All right, we'll have another maybe 3 to 4 minutes. I'm going to finish a little bit earlier. Kind of did my homework in terms of earnings. Any questions on calendar spread? Right, we covered a lot. Right, we talked about calendar spreads. Think about to simplify what a calendar spread. Right, first, not calendar spread, but butterflies. First, let's talk butterflies. These are nothing but two spreads. If you understand what a call spread is, then you can understand what a butterfly is. Right, because butterfly is just you buying long debit call spread and you selling credit call spread with the same strike, right? So debit spread and a credit spread, right? And it becomes kind of a market neutral. Well, in my case, I'm directional, right? This is a directional butterfly. I have to move to that. But if I did the middle strike right where Adobe is trading, right? You can be save a lot. I mean, nobody knows what's going to happen, right? You have no idea, right? I think it's going to be within one standard deviation move. Okay, no problem. You can structure a trade if you think it's going to stay at 450. All you do, you can, that's what people also do. They do butterfly, right? They say, okay, I'm going to sell 2 contracts at 450, and I'm going, I think it's going to stay in the range, let's say 400 to 500, right? So I'm just going to do $50 butterfly. I mean, it's expensive relatively, so you have to figure out how much money you willing to risk, but that is something that you can do, right? So debit spread, calls, it's two spreads, right? You can do, some people do, instead of a butterfly, they do condor, right? Sorry, color. No, sorry, condor, call condor. They can do call condor, same thing. You buy in a debit spread, you sell in a credit call spread, but you have different strikes, right? The middle strike is not the same, it's different. You pay in a little bit more premium, right? So your return on capital decreases, but your probability of success increases, right? When you structure your trade, you either can increase the probability of success or you can increase return on capital. And based on your personality, you might want to consider one or the other, right? The idea is never do this, always do the same, right? If you always long volatility or if you always short volatility, that's not the right strategy, right? You need to understand market conditions, you need to understand volatility, skew, positioning, fixed vol strike, and then realize whether you want to be long or short volatility. Any questions on Tradier? Any questions on Discord? Any questions on TradingView? I just joined. Did you speak about Adobe? Paul, welcome. All right, a lot more people are like Adobe trades. Okay, yes, I did speak about Adobe. Let's rehash Adobe trade. So in example of Adobe, I decided to be long volatility. Why? Right. First question: long or short volatility? Adobe is the AI play. At least they claim they're AI. They're not building chips, but their software is going to help designers generate design, without writing code. And actually, now I'm a developer by trade, and I can see that every single developer is now using ChatGPT to write code. It always becomes an integral part of your process. So whether you're designer, developer, marketer, AI is here to stay, right? So the question is, well, can you monetize that? Can you actually make money? Based on not what I think, but based on positioning, right? If I look at the positioning, I can clearly see that the weighted vol skew is below 0.50, so it's a risk reversal. People are selling puts. because there's a lot of premium in the options and they're buying calls, right? So you do have a risk reversal. And my proposal in this case to be long volatility. Bob likes to buy straddles, right? Somebody could buy, calendar spread. We had example of calendar spread, butterfly debit spread, but a strategy where you pay in debit and you have a directional view, right? It could be a butterfly where it's neutral. It could be directional butterflies, but that's my proposal. Based on where people think it's going to go, people think it's either going to go to 390 if they again miss, if they can deliver on the bottom line and top line, or at least like Oracle say that we have $1 billion worth of backlog, right? The stock is going to drop and potentially gravitate toward 390 because of the VANA, the second derivative, and the flow in volatility. If they are actually able to deliver on the top and bottom line and say, listen, we have all these designers paying us, $1,000 a month for recurrent subscription fee. Well, that's, then you can make money and then it will gravitate toward 530 level. So that would be my analysis. So either you can do what I propose to either do a calendar spread like we did with HPE, right? HPE, there was very high open interest at 21 strike. Now and you do both on puts and calls, unless you have strong opinion that, Adobe is going to go up. But you do counter spreads on both sides, right? You do counter spreads on both sides. You can do same strike or you can do diagonal, right? Maybe say I'll buy 530, next week, but this week I'll sell 535. Right? It's possible 540, right? Just depends how much money you want to risk. So that is one option. Do on both sides, pick the strike prices, right? In this example, I would pick personally 390 or 530, right? You either pick 530 or you pick 390 strike. With the idea that it will gravitate the VANA exposure and the gamma exposure for the dealers will force them to defend their position, right? They have to be delta neutral. So it will force them to either buy the stock if it gets to close to 400 or sell the stock if it gets close to 530, right? So that would be my proposal. I decided to kind of mix it up and don't not wait till the next week. We'll see if it was a mistake or not tomorrow. But I decided to do a butterfly, 515, 530, and 545 call spread, right? And same thing on the downside, 375, 390, 405 put. So butterfly buying one, selling two, and buying one, right? Any questions on a question? Paul, support resistance where? Adobe or Spiders? Spiders. Okay, thank you, Paul. So in terms of our model, right, you can basically see, you can go into, you can analyze any stock, right? So if you type in, with analyze CMG, let's analyze Spiders. So the model sees 539, 544 is a support, right, on Spiders, and still in strong uptrend, right? The model actually, we've been talking about 548, 550, 560 level. It looks like we're slowly gravitating toward these extremes. So for Spiders, and in terms of positioning, right, we talked about that most position is at, sorry, Lucy, yeah, we're about to be done. Hold on, give me 1 second. So Spiders, the breakout. So there's pretty high open interest at the breakout level, 530. I would call it 530, 535. That's your first level of support, right? The gap. If we close the gap, drop below that, then that would be negative. If we drop below, as long as we're above 530, right? As long as we're above 530, it's a pattern of higher highs and higher lows. If we break below 530, the next level of support is 520, right? The 50-day moving average for Spiders. Any other questions? All right, guys, you've been awesome. I appreciate support. A lot of more people are showing up, so I love it, even though it's June and usually a slow time of the year. Tomorrow, Scott will do the morning session. I will do the closing session. Let me show you my face again, so you guys uh, don't think I'm gone. I'm here, right? Thank you very much for participating. Appreciate your time. All eyes are on Dobby. Let's see what happens if, based on distribution of outcomes, if you will have this exaggerated, not exaggerated, but two standard deviation move, both similar to Oracle or HPQ and HP. Thank you very much, and have a great day.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.